Good morning, everyone, and welcome to the Capis Research Call. My name is John D'Antonio. I'm the Director of Marketing here and your host. Capis would like to thank all of you for taking the time out of your busy day to spend with us during this call. We hope you find the following information in today's presentation useful. In order for us to serve you better, there'll be a brief survey at the conclusion of the call that we'd appreciate you filling out. So thank you very much in advance. But before we get started, there's always the legalese. The opinions expressed by the featured speakers are neither those of Capital Institutional Services nor its employees. This presentation is not, and nothing in it should be construed as an offer, invitation, or recommendation to sell, or a solicitation of an offer to buy the securities, any of which might be mentioned today. And now, on with the call. First up to speak with us with a market update on Capis and our operations is Ed O'Dowd, Senior Vice President in Institutional Sales here. Take it away, Ed.
Thank you, John. Appreciate it. Good to be here. Welcome Capis clients and friends of the firm who've joined us today on our monthly research call today with Nick Colas at DataTrek Research. And it's interesting here in June, a little bit of I was talking with Nick and John before the call. It's a little bit like we're in the summer mode right now, kind of a June gloom, if you will. There's been, on our trading desk at the firm, maybe a little less volume than we'd like. And I think there's a few factors there. One is typically this time of year, vacations are starting. And I think there's been some pent-up demand from clients I talked to that maybe didn't vacation last year and are hitting the road now. So because of that, I think we're seeing a little less activity. The other thing I think that is a factor in talking to clients throughout Q2, actually, and having these conversations is this situation where there's been less volatility. The market's kind of melted up. People have had great returns in equities the last few years, and particularly the last, say, 18 months. And they don't see any cheaper alternatives. There's really not as much activity sometimes, I think, because people love the names they're in or they've had a great run, but they look at other opportunities and they think, well, the valuation might be higher now. Doesn't seem like a great alternative. So they're kind of staying put with what they have. They're beating their benchmarks or at least meeting them in some cases. So that's a factor. The one thing that we always see from our clients, though, that a desire and having conversations with them is content. So regardless of that, our trading desk is always in contact with our money managers. Our salespeople are in contact with our clients and trying to get them content. This monthly call, we have a daily research email we send out in the morning, a daily note, I should say. We also offer a holdings list that we send out an email once a day in the morning that is tailored to a specific client. You tell us what names or holdings you have, whatever names you want us to load, and we send out an email every day about 7:30 East Coast time with any information, any news on those names in the past 24 hours. Gotten great feedback on that. So reach out to your Capis sales rep or trader if you think that's something you might be interested in. Yeah, I'm interested in Nick's comments today, particularly yesterday with the Fed indicating that, we could see rate hikes in 23. So I'm interested in what Nick's to say about that today and other things he'll cover. And I wonder with that and maybe inflation fears, if we will start to get more of that volatility that we've definitely had in the past and maybe haven't had as much in recent times. But I'm wondering if some of that's expected to come back. So, John, you could introduce Nick, and I'm really excited to get on with the program and hear what he has to say. Thank you.
Oh, that's great, Ed. Thanks so much for the update. And now I'd like to turn it over to Nick Colas. But before I do, please note that Nick and or Jessica, who is with us, will take questions at the conclusion of the remarks. Please be sure to type them into the Q&A portion of your Zoom, and I will be sure to get to them. Again, following the call, there'll be a brief survey, and we'd appreciate it if everyone would take just a few minutes to complete it and help us at Capis here serve you better. So here we go. Nick Colas is one of the two founders of DataTrek, a research firm focusing on market fundamentals designed to make the investment process more profitable, robust, and efficient. Colas is a 30-plus year veteran of Wall Street with experience in equity research, money management, and investment banking. From 1991 to 1999, he was the senior equity auto analyst at First Boston, which is now Credit Suisse. From 99 to 2001, he was an analyst and portfolio manager at SAC Capital, reporting directly to company founder Steve Cohen. Most recently, Nick was director of research and chief market strategist for first Rochdale Securities and then Convergex Group. Nick, as always, welcome.
Hey, thanks so much. And thank you all for taking the time to listen in. We've got, I think, a pretty interesting program today based on the kinds of things that the campus folks wanted to talk about, which turned out to be exactly what we should all be focused on. So let's just start going through them. There's three topics we're going to cover today. First is the history of taper tantrums and rate cycles, obviously very relevant given what happened yesterday with the Fed and the FOMC. Second, we're going to discuss some recent trends in fund flows and what that means for the growth of ETFs, what ETFs mean to market structure and asset pricing. And the third is we're going to cover very briefly some mobility trends that we track around the world using a bunch of crowdsourced data that we have found very reliable in picking off levels of growth and levels of recovery from the pandemic lows last year and create actually very investable ideas coming out the other side. So let's dive right in. Let's start talking about the taper tantrum. And we're going to start with a little myth busting on this because there's a lot of lore around the 2013 taper tantrum, and most of it's really misleading. So let's just start with a couple of basic facts about the 2013 taper tantrum. First of all, it was not because the Fed started to cut its bond purchases, which it has started to make in 2010 and 2011. It was not because of that. The bond purchases actually started to be reduced in 2014, not 2013. The 2013 taper tantrum was 100% due to Chairman Bernanke's very off the cuff and frankly ill-considered comments at a May 22nd congressional hearing on the question of when the Federal Reserve was going to start reducing its bond purchases. And he basically off the cuff said, it could happen over the next few meetings if the economy continues to improve. And that was the first time anybody had heard a real timeline about when the Federal Reserve was going to start tapering. And that really set markets off. If you look at a long-term chart of the 10-year, you'll see it broke 2% literally on May 22nd, 2013, when Bernanke said that, and went right to 3% in September. That was the tantrum. It wasn't that the Fed was cutting its bond purchases. It was that they didn't communicate particularly effectively or consistently when they would start and what the guidelines were going to be for how much they would do, why they would do it, and so forth. And the Fed tried to damage control this over the balance of 2013, and it just didn't work. And by the end of 2013, after a little pullback, yields were back at 3%. So you saw a 100 basis point move off the bottom in about 6 months, purely because the Fed chair did not communicate well. Now, when tapering actually started, which was in early 2014, yields went down. They went down from that 3% level back to 2% because at the end of the day, inflation just wasn't all that robust. And the 10-year works around long-term trends in inflation. And after it saw the tapering wasn't really having much of an impact, yields declined again. So it's not that the taper tantrum was anything to do with anything other than miscommunication by the Fed. Another point, another myth, if you will, is that the taper tantrum affected stocks because obviously if yields rise, why wouldn't stocks go down? But the reality is 2013, the year of that taper tantrum, was the single best year for the S&P since 1997. It literally is the best year since 97 to right now. It was up 32%. So it was a monster year for stocks. The Russell was up 39%, the best year of this century, the 2000th century. And the only geographic area to lose money in equities was EM. Emerging markets were down 2%. And as much as people think EM is kind of a beta bet on global recovery or global expansion, it really isn't. EM, and this is the MSCI EM, EEM is the symbol, has lost money in 5 of the 10 years of the 2010s. We don't like EM now, by the way. It's just, it's not a moneymaker. But importantly, back to 2013, it was a really big year for stocks. So just keep that in mind when you read about taper tantrums. It wasn't really caused by bond purchase reductions. It was caused by miscommunication. And that's why Powell is so circumspect on this topic right now. I mean, he sounds like a diplomat whenever he discusses tapering because he understands this 2013 history extremely well. He understands that it was basically a misstatement by the Fed chair that created the tantrum. And it was a communication failure, not really a policy failure. So that's why Powell is so cautious on the topic of tapering. And I think I'm certainly convinced that we're going to hear about tapering, basically at every time there's a Fed speaker for the next 3 months, but they're going to ease the market into this concept. And if anything, the Jackson Hole meeting in August will be when they give a more robust timeline. But it's going to be very slow, very patient, and very carefully communicated because that's what caused the tantrum. It wasn't actually when the Fed started to cut back on bond purchases. Now, we need to briefly touch on rates because as Ed mentioned, we did get a little bit of a surprise out of the Fed yesterday with that move from 0 rate increases in 23 to 2 rate increases. What we told clients last night in our daily email to them is this feels very much like the countdown clock has started on rate increases because it's not that the Fed says 2023 is the day. It's about the rate of change. It's about how the Fed is communicating rate policy. And this was just the first shot. If the economy continues to improve, I think you can well expect to see those expectations for a rate increase move forward into late 2022 after tapering is underway. And that's what I mean when I say that the shot clock has started on the rate increase cycle. And if you believe that, and I think it's a reasonable assessment, then it's important to understand the history of what the S&P does, what U.S. stocks do when the Fed starts to increase rates, because this is sort of de facto a way of the Fed positioning themselves to start raising rates. So if you go back, there's only been 4 rate cycles since 1990 to the upside, meaning the Fed is raising Fed funds rates. And the equity record on them is mixed. The first one was in 94. And this was a slew of 50 basis point rate increases. Those of you on this call who remember 94, remember it was a hugely painful year. The S&P was up 1%, but I think it sold off 20% from April during the first rate increase to the lows in August and September. And cyclicals rolled over. It was a very tumultuous year in equities, a very tough year to make money. But it was because the Fed had moved so quickly, went from basically 3 to 6% Fed funds rates in less than a year, raising them at 50 basis point clips on occasion. And that's why the volatility was so high. Once the Fed stopped raising rates in 95, the S&P was up 37%, one of the best years of the post-World War II era. So when the Fed was raising rates in 94, yeah, it definitely hurt stocks. The record's a little bit different on the other 3 rate increases cycles. 99 and 2000 was affected by the dot-com bubble. And the Fed really overstepped to some degree, raising rates in 2000, which is why the dot-com bubble began to roll over. They took rates to cycle highs north of that 6% level from the 94 rate cycle. And that's what really gave the market, a real concern of what the Fed was doing to the economy. 2004 to 2006 saw a rate cycle, but at a much slower pace. 25 basis points, rates still went up a lot from 1 to 5%. But the S&P ran positive returns in every year from 2004 to 2006, between 5 and 15%. And the last rate cycle, we all know, I think remember pretty well, 2016 to 2018, 0 to 2.5%. The S&P was up 12%, then 22% in 16 and 17, but rolled over when the Fed was clearly tightening too much. And you all recall how Powell had to step down at the beginning of 2019 and start cutting rates again. The takeaways from this discussion, I think, are twofold. The first is we're not worried about the Fed, screwing up the tapering messaging. The market understands what's coming. They understand it has to occur. I think they would actually feel good that the Fed was less involved in capital markets than they are today. And the Fed's going to focus on communicating this well. So we're not super worried about a taper tantrum. And the history even shows that it doesn't really affect stocks. The second is that the market can definitely absorb the Fed pulling forward rate increase expectations over the next year, as long as economic growth is commensurate with that kind of shift. If it's purely about inflation, obviously all bets are off. But we have a pretty strong point of view that the inflation that we're seeing right now is largely transitory. And we can go into that in another call or during Q&A, but the data is very clear. The inflation is from things like used cars and gasoline, the kind of things that level out over time. So markets can absorb higher rates as long as they're not related to inflation. We don't think they will be. And as long as the economy continues to improve and earnings power continues to improve, that is fine for stocks. We're still positive on US stocks, but mostly because we think earnings numbers are still way too low for the back half of the year, like by 10% at least. Analysts have been very slow to raise their numbers. That's enough to offset the rate cycle chatter, but totally get it. I was, as you heard, I covered autos in 1994, and it was a brutal year to cover cyclicals when the Fed was raising rates. I don't want to lead anybody down the garden path and say it'll be easy, but it is manageable, particularly if they go slowly. Now, let's move on to our second topic, which is money flows, fund flows, really, and ETFs. And let me give you a little bit of setup here because the data is really important. We're using Investment Company Institute data, basically mutual funds and ETFs domiciled here in the US. And the important thing to understand is that US fund investors have been selling down their equity exposure for years. Outflows of $169 billion in 2019, outflows of $282 billion in 2020. And this was not related to really the pandemic or anything. This was just structural outflows. And that was a big problem. You know, as much as the equity markets were working, particularly in 2020, fund investors were redeeming $30–40 billion a month every month. Now, here's the weird thing, and this is legit weird. In 2021, fund investors have been buying US equity funds for the first time in years and buying them pretty consistently. $67 billion of inflows year to date. The strongest numbers were in February and March, weaker in April. May was better again, but it's been pretty consistent. And honestly, we've looked at this data for years and years. And I honestly cannot believe how strong these flows numbers have gotten. It's almost like, you know, mutual funds and ETFs have kind of become meme stocks where investors are just putting their money in. And it really stands in stark contrast to what we saw for the better part of a decade. You know, there was a reason why the decade of the 2010s was called the most hated bull market in history. It's because fund investors were selling down their equity exposure every single month. Now, why is this worth watching? Why is this worth discussing? First, we got to ask if those flows are sustainable. Is the recent trend of now people putting money into funds a sustainable feature? And it's really choppy. Last week, I was just looking at the data this morning. Last week saw outflows of $14 billion out of US equity funds. And that shows you how choppy these numbers can be, because as much as we have $67 billion of inflows, we have $14 billion of outflows last week. So it's not really, you know, smooth sailing. The second, and I hear this a lot from clients, is are retail fund flows a sign of a market top? And that's a very fair point, because as I mentioned, retail investors have not had a great track record of calling the market over the last decade. They've sold when they should have bought. And while they've done a little bit better of late, making some good purchases earlier this year, the long-term track record is that when you see retail fund flows or fund flows into mutual funds and ETFs that are positive, tends to be more of a top than a bottom. So that is, to my mind, a very mixed picture. The fund flows, it's very nice to see the fund flows are positive, but after being negative for so long, but as a market signal, I'd bias it towards being bearish, honestly. I don't think it's a great positive sign as a contrarian indicator. Now, let's talk about ETFs, because that's a really interesting subtopic of this. And given the numbers that I've just rolled out to you, it puts the conversation into a little bit different direction. ETFs, as we all know, have been growing their market share versus mutual funds for the last 15, 20 years. And there's a good reason for that. ETFs are kind of a classic innovative disruption technology that looks a lot like Amazon or even Japanese cars in the 70s as a paradigm of disruption. Because what happens is ETFs started at the very low end of the market with the SPYs back in 1993. And then as those began to gain traction, new ETFs came along, almost always index-based, and added to that. Just the way Amazon started by selling books, then started selling CDs, and now sells everything, ETFs have gone the same way. So it's no surprise that a low-cost option with intraday liquidity is going to be popular and continue to grow in popularity. But one thing we hear from clients a lot is the question of how does this change stock prices? Does it elevate them? And the most important point is to remember that on a net basis, fund flows have been negative for the last 10 years out of US equities. So as much as everybody talks about ETF flows, the other side of the trade is there's been more than that in terms of mutual fund outflows. So the net basis is actually lower. There's actually less impact. The ETFs will have more intraday impact because they price intraday. But in terms of, is there more fund flows into funds? The answer is no, at least not until this year. The other question we get a lot is, does it affect things like market correlations? So if you have an ETF like SPY or IVV that's just the S&P and they're very popular and very large, does that tend to jam correlations together because the same amount of money goes on a formulaic basis into all 500 stocks pretty much every day, in or out? Does that push correlations together? And the math says no, it does not. We've looked at correlations now for the better part of 15 years across sectors in the US equity market, and correlations vary just as much as they have in prior cycles. So when you get a market crisis, correlations all go to 1. And then you get an economic recovery and correlations begin to fall. And by the middle of economic recovery, sector correlations are running 0.5, 0.6, which is kind of right where you expect they would be. So it has not yet really affected market dynamics. Now, this doesn't mean that there's no change. The change that I would tell you that I think about the most is that ETFs clearly make investing more quantitative. They force investment themes into quantitative approaches, whether it be an index or a measure. So for example, ESG funds. You can't run an ESG fund all manually. You can't have analysts go out and check every company and talk to the managements and talk to the workers and talk to the customers. You need a quantitative approach, because one thing that ETFs have done is push down fee structures. And so as a result, you can't charge 300 basis points for an ESG fund. You can charge maybe 75, maybe 50, but that means you have to automate the process. And this is why Larry Fink is so focused at BlackRock, is so focused on having quantitative measures of ESG, because it's the only way that paradigm works. And so if there is an effect, and I think it is a profound one, it's that ETFs are part of a larger theme to quantifying investing. They happen to be the most visible tool of that quantification, because as you want to launch new products as an ETF sponsor, whatever inputs you use have to be entirely automated. And that is part of a larger, societal and macro trend, but ETFs happen to be one place where it's so super visible. So let me just give you the investment conclusions from here. Bottom line, we're at a tricky place right now in terms of retail investor interest in the stock market. We all talk about meme stocks and kind of laugh at them, but they are part of a larger trend. Americans have been more aggressively buying equities, and we see it in fund flows as well, but it could easily be a market top sign versus any kind of structural improvement in fund flows that could help stocks for years the way they did in the 1990s. And then secondly, ETFs are certainly a force. Don't want to minimize that at all. But at the same time, let's put it in context. The fund flows net have actually been negative for the last decade. And ETFs certainly have a role to play in investing, but the thing to think about is, how does a more quantitative world change asset price or price discovery? And that to me is the most interesting long-term trend. Now let's flip over to our last topic of the day, which is mobility trends around the world. And Jessica and I use 2 data sets, like literally every day. Apple Mobility, which basically tracks the number of rerouting requests on the Apple Map app. And the proxy there is, if it sees more rerouting requests, it assumes there's congestion. And more congestion means more traffic means more economic activity, and faster return to normal from the 2020 lows. The other data we look at is TomTom, which is a GPS service more popular in Europe, but also used here. And it looks at how many pings it basically gets from users who are actually on the road. So another measure of mobility. It's a little more granular than Apple Mobility is. Both are free. Feel free to use them. We use this, as I said, all the time. The only caveat is that China stopped contributing to TomTom data recently. So we've been forced to use air quality readings as a measure of economic activity. We're not going to discuss those today, but if there's interest, we can discuss it in Q&A or in a future call. But mobility trends, using those 2 tools kind of have given us two big takeaways about what's going on in 2020. The first big takeaway is the European economy is coming back really strong. Stronger, frankly, at the margin than the US economy right now. And there's good macro reasons for that. You know, Europe had a much longer set of lockdowns. It also had much less fiscal stimulus than the US employed to basically get through the pandemic. So the snapback is faster because the lockdowns have been there and because the US spent a lot of money, frankly, making sure that the 2020 economy didn't roll over entirely. And so it was a whole different approach in how we provided macro support versus Europe. But the net of it is the European recovery is happening quickly. We like a couple of groups or a couple of geographies. We like the entire sort of MSCI Europe equity index. IEUR is one ETF that covers that. And we really like the UK as well. The UK has a little bit different story from continental Europe because of Brexit, obviously. But we think that adds a sort of turbocharged element to the UK equity story. EWU is the symbol there. You can check those out. Keep in mind that the European equity markets are much less technology based and much more cyclical than the US. So for example, technology is like 2% of MSCI UK and 8% of MSCI Europe. It's obviously like 27% of the US, not including Amazon, Google, and Facebook. With that, it's well over 30. So when you're buying European equities, you are buying a recovery story. You're buying financials, industrials, consumer staples, consumer discretionary. Those are the big chunky sectors in Europe. So it happens to be a good fit between that faster recovery, more earnings leverage, and indices that are much more cyclical than we have here in the US and the S&P. The second thing, and this is sort of goes right back up to the top of our discussion about Fed policy, is that it's very clear that mobility trends in the US are really still centered in the suburbs. People are moving around in the suburbs because like 1 million American households moved out of cities to the suburbs last year. And that's what created the big surge in house prices. But so far, they're really staying there. When we look at mobility data for, say, New York or LA, Chicago is a good example. The traffic levels aren't coming back all that quickly. The congestion's not there. I'm actually based in Midtown Manhattan, so I see this every day. The traffic is improving, but it's still nowhere near where it was 18 months ago, 2 years ago. And the mobility data shows that very cleanly. People are not yet commuting back to work for a whole host of reasons, and it's very visible. That's important for one huge fact, and that is that the unemployment picture or the unemployment problem in the US is absolutely centered in just a handful of states and frankly, just a handful of cities. So if you look at state level unemployment, there are like 25 states with well below average unemployment right now. And unemployment is basically high in New York, California, and then a couple of other areas around the country that have big cities in them. Unemployment in New York is still 10%, same in LA. And it's because that mobility is not moving back into cities yet, because you're not getting commuting, you're not getting the big conventions, you're not getting the travel and leisure and hospitality demand in New York and LA and a couple of other cities. And until the mobility trends start to show people going back to the office 5 days a week, those unemployment levels are going to stay high. And they're going to stay high regardless of whether there is unemployment insurance overrides, incremental benefits. It's going to stay high regardless of Fed policy. It's going to stay high regardless of tapering. It's a structural problem. So as you've looked at the last couple of unemployment reports, this is shown through very clearly. People were really surprised, like, oh, we didn't get a 1 million job print. Jessica and I were not surprised. We were happy it was even 600,000 because when you parse the unemployment data correctly, you find that there's just structural problems in big cities that happen to have high percentages of workforces that are in leisure and travel and hospitality, things related to life in a big city where commuting is a big part of the economic output day to day. So that's going to continue through the summer. Don't expect us to have any big 1 million job prints over the course of the summer, regardless of the pace of reopening, because these structural issues in cities are really the driving factor. The mobility data shows it very cleanly. So that's more of a way of saying, sort of, and summing this up. Obviously, we like Europe. We talked about that. But let's have some realistic perspective on what the unemployment picture can look like for the next couple of months. And let's not think that it's all related to Fed policy or fiscal policy. There's just a big structural element in this. It's not going to get resolved until Q4. That'll probably at some point tell the market, well, maybe the Fed is right to keep tapering going. Maybe the Fed is right to keep rates, maybe they got they decided, maybe the market decides 2023 is not the right time for a rate cycle. We should all just relax. It'll get fixed, but it's only going to get fixed when people are commuting back to the office full time. And that could be a while. So that is it for our formal comments. John, happy to open it up for questions.
Yes, thank you, Nick. I do have a question here. Someone who was asking about interest rate hikes coming, and they were curious, what's your take on it? I think you alluded to it, said it just a few minutes ago, but can the market expect a more aggressive Fed? We know rate hikes are coming, but could we expect a 50 basis point move as opposed to 225s, or are we just really splitting hairs here?
No, it's a super important difference. It's a great question. The Fed understands that 50 basis point hikes are very disruptive to the markets, and they learned that from the 94 experience. And as I said, if you lived through 94 in equity markets, you remember this vividly. Like I still remember where I was sitting when I saw the 50 basis point headline. So the Fed understands that you can't do 50 unless it's basically an emergency. But to the prior sort of iteration or the prior part of that question, my belief is that you're going to see the Fed did this very intentionally yesterday. They wanted to put rate increases on the table. So they put them out there for 2023. And their intention, if the economy continues to improve, is to move forward those expectations over time and literally tiptoe their way into conditioning the market to believe in a rate increase probably in the back half of next year, if the economy gets all the traction that the Fed thinks it should. And that's entirely consistent with kind of the lessons that I tried to lay out in the first point of this conversation, where the Fed has grown to understand that you condition markets slowly and execute slowly, no sudden moves. You let the markets kind of absorb your message, decide where to price assets, and then you incrementally change the message and decide to reprice, and the market decides to reprice assets wherever. The Fed wants to take itself out of the game of creating volatility, as it did in 94, as it did in 2000, as it did in 2018. The Fed wants to be out of that market, out of that game. And so they're going to do everything possible to just tiptoe it in. So my expectation is in 6 months' time, when we do our year-end call, we'll be talking about the Fed probably having an expectation of a rate increase in 2022.
Okay, Nick, thank you. Another question. This one pertains to ETFs. What do you make of the trend in more and more thematic ETFs, such as space, robotics, circular economy, etc., that seem to have constituent holdings that they don't feel like they really fit the theme very well?
Yeah, it's a great question. Not to name names, but there's a certain space ETF that has had John Deere as one of its top holdings. And I was like, okay, I kind of get it, because eventually you're going to have tractors on the moon, but that did seem like a reach. So a couple of points on thematic ETFs. The first is, at the margin, I think they're good for the functioning of capital markets, because anything that isn't related to just the market cap of a company or its participation in a given index, anything that is thematic or non-correlated to basic attributes is at the margin a good thing. It says that the stock price will be affected by something besides its market cap or its participation in an index. So I like it. The thing that I don't think investors fully understand about thematic ETFs is that they're a lot like venture capital. So if you're a venture capitalist, you have $100 million and you put it into 10 good ideas, 20 good ideas. The only thing you know for sure is that 3 of them will suck and they will implode in the first 2 years. And you have to live through what venture capitalists and PE investors call a J curve. The first couple of years of your fund are not going to be good, because you're going to make some mistakes. And if 3 of those 10 implode, you're going to take the write downs in years 1, 2, and 3. What you're betting on is years 4 through 10 have big payoffs on the names that didn't blow up. And, it's a lot like equity investing. I think all of us know, like, In most years, your wins come down to a handful of awesome ideas that you happen to scale correctly. And it's a lot like that in venture capital. You find 2 or 3 awesome ideas and you have 100 backers, and that's the entire return of the fund. When you buy a thematic ETF, you kind of have to dedicate a 5 to 10 year time frame for it, because a theme like space, for example, which is very nascent, is going to take time to work out, and you have to give it time to work. And all you kind of know is the first couple of years might be, almost certainly will be, very rocky. So there's an analog between these kind of products and venture investing that I think is important to consider when you're buying a disruptive tech kind of theme. There are other themes like legal marijuana or biotech that are much kind of cleaner in terms of their payoffs and in terms of what they try to do. But for those big, sexy, disruptive things, obviously be careful. But secondly, like, think differently. Think like a venture capital investor, because they're not like buying IVV or SPY.
Thank you, Nick. I have another one here. Someone's asking for your perspective on the housing market. And they're asking, is it purely a supply chain issue impacting the market?
Ooh, okay, yeah, great question as well. Short answer, no. It is not just a supply chain issue. It is, well, it's not a supply chain issue for construction. Let's put it that way. It's funny that the housing market obviously had a big rip going into the middle 2000s and then fell apart with the financial crisis. And then it took a long time to crawl its way back. It was really the better part of a decade before house prices at a national level fully recovered. And I think people were still a little bit scarred by the financial crisis and the housing bubble. And house prices didn't really move that much from, say, 2015 to 2020. And so to some degree, I think this big liftoff we see in things like the Schiller Housing Index are a little bit of catch up, frankly, both in terms of, because of low mortgage rates. Mortgage rates are still like 3% or a little bit less, which is crazy when you think about it. And it's a little bit of catch up from just not having really, run very much post housing bubble. The urbanization trend had also slowed down house prices, and it all kind of reverted to some much higher level in 2020, where you had, as I said, the way Jessica has counted it, and I agree, it's like 1 million plus households left major cities and moved to the suburbs in the space of like 6 months. And so you had this huge bump in demand and not a lot of supply. And now you're getting the supply coming online, but it's coming all at once, and things like lumber prices spiked, metals prices spiked. That'll all revert to some more normal level in the future. What'll be fascinating, and I don't think anybody has the answer to this, is does the urbanization trend begin to kick back in again in 21, 22, 23, or is the suburbanization trend basically here to stay? Because we were talking, before the call, there's a lot of psychological studies that show that your length of your commute is the single most important driver of your day-to-day happiness of anything in your life. If your commute is 2 hours, you're going to be miserable, regardless of anything else going on in your life. And if your commute is 20 minutes, you're going to be happier, everything else equal. Committing to the suburbs means committing to commuting, unless you can convince your boss to let you work from home or a satellite office. So I'm skeptical that the urbanization trend lasts that much longer, but I understand why it happened. So I don't really have a strong point of view about house prices. I view them more as an interesting, and really one-off demographic shift that probably is the single largest shadow cast by the pandemic in terms of how it shaped American society.
Thank you for that answer, Nick. And here's another one. There's been a lot of discussion about what metrics are good reflections of economic reality. What do you utilize as some of the most true indicators of inflationary trends?
Yeah. Boy, it's a great questions today. So we look at, a couple of things. We start with the CPI, because even as flawed as it is a useful long-run measure. However, the way we get to the truth, and this is grimy as hell, but the way we get to the truth is we go back and look at the weightings for the CPI all through the 1970s, because the 70s experience, and for those of us who grew up in the 70s, is still very vivid. The 70s inflation experience is what everybody's worried about. And then you have to go back and look at the CPI in the 70s to kind of get a sense of how did those numbers come around? Because when you look at a CPI chart, all you see are big spikes in the 70s, and then it goes away. And inflation seems to have been tame ever since. So what was going on in the 70s? And the answer is the CPI was dramatically different in the 1970s. So for example, 73, 74, first bout of inflation, oil shock in October 73, food prices were a third of the CPI basket. So the average household spent a third of their income on food. That's why when food inflation took off, and it was up like 25% year over year in some months, that's why inflation felt so bad. And again, for those of us who were there, we all remember going to the supermarket and buying stuff for the family and not having enough money. That's why that inflation felt so bad. Food is only 16% of the CPI now, much less. So food inflation, even if it were to replicate 73 levels, wouldn't have as big an impact on CPI. Another thing is housing inflation, which is a really important topic. Housing inflation in the CPI in 79 was based on interest rates. It was literally a financing computation, and housing was 5 points of the 15-point inflation that we had in 79. So CPI was 14.9, I think. 5 points of it was housing inflation because interest rates were 22% and mortgage rates were 16, 17%. And that's why that CPI peak is so visible in the long run chart. It looks scary, but you got to remember that the BLS kind of figured this out. And in 1983, they changed the entire CPI calculation. And it became based on owner's equivalent rent, which basically is a survey of how much your house would rent for. And housing inflation has never been 20% again. It's been 6% at the peak, and that was in 86. So when I think about that's a long way of saying, when I think about this question of what is real inflation, what is true inflation, I always start with the statement that the numbers that we see on the CPI chart from the 70s are irrelevant to today. They do not tell us anything about where inflation can go because the calculation was just so different. American society was different. American budgets were different. So as we think about inflation expectations, and I think Powell had this right, I look at gas prices a lot, maybe because I was an auto analyst for so long, but I think people measure their real world inflation through gas prices. And if you want to tell a story about real structural inflation, tell a story about how oil goes to $120 a barrel and stays there, which, in an upside case, it absolutely could. It's nothing the Fed can do about it, but it will replicate exactly what happened in 73 when oil prices went from, literally $2 a barrel to $10 a barrel as a result of the October war. And that's what I think about. It is about gasoline prices, it's about oil prices. It's why we tell clients never underweight energy. We like energy here. If you're looking for a real inflation hedge, energy is the hedge. It's only 3% of the S&P, but it is your only hedge for real structural inflation outside of something like gold. But we like energy a lot better because as demand rises and as the economies improve, that's what's going to drive inflation. That's our measure. That's what we look at.
Okay, Nick, thank you. And at this time, we'd like to conclude our monthly Capis research call. Again, thank you, Nick and Jessica, for sharing your thoughts with us. Our next call will be sometime in mid-July with the actual date and speaker TBA. So please stay tuned for more information. On behalf of the Capis family, we'd like to thank you for watching, and everyone have a great trading day. Thank you.